Hi folks, and welcome to Become Financially Independent. My name is Björn for those who don't know me, and today's topic is the crash of China's tech and education stocks. So if you want to know what and why that happened and what you should do now, buying, selling, or if it's better to do nothing, that are the questions. So stay tuned. First and foremost, it is not a China bashing video. I will try to be as objective as possible, as I will explain the situation as well from the Chinese perspective, as I got some insider information from some Chinese friends. So let's get to it. China's government caused a stock market panic. The share prices of numerous companies have been plummeting for a few days. Tech companies in particular are suffering, as we know. The Nasdaq China Golden Dragon, for example, in which the US shares of Chinese companies are gathered, is heading for the heaviest monthly loss since the financial crisis, as you can see on the chart. With that, $1.2 trillion of market value have been vanished into thin air. The reason? Beijing has introduced massive regulatory measures against technology companies. First of all, there are companies that have large amounts of data, and companies that are listed on the US stock exchanges are also targeted. And now the focus is also on the education sector. But other industries are also affected. So, this wave of regulation is also causing heavy losses on the Shanghai and Hong Kong stock exchanges. In Shanghai, the CSI index, which includes the shares of 300 largest listed companies from the mainland China, lost around 8% in July and thus suffered greater losses than in the corona shock in February last year. And you have to understand that this is not because of some private investors selling. No, it's because big investors or institutions like BlackRock or Vanguard etc. are selling as well. And therefore we can see this huge drop. Beijing's new course became visible for the first time when DIDI Example went public. The successful transport service provider, which ousted Uber from China, went public in the US at the end of June, even though China's cyberspace regulators had previously strongly advised against it. Shortly after the triumphant stock market debut with massive price gains, app stores in China were banned from continuing to offer the DIDI app for download in China. The share price therefore collapsed. But that was just the beginning. DIDI has to prepare for a severe punishment. Hence, it looks like Beijing will make an example of DIDI here. Because founder Cheng Wei challenged the state and the party leadership with IPO. But that's not the only reason. Beijing wants to keep domestic tech companies away from foreign stock exchanges. Perhaps the government fears that they could be forced by the local authorities to make their huge amount of data available to them. And China's authorities want exclusive access, that's for sure. The result is that Chinese tech companies have now put their US stock market plans on hold, including the TikTok parent company ByteDance and the medical data service provider LinkDoc. Meanwhile, the courses of US listed companies such as the online giant Alibaba, the search engine operator Baidu, and the social media giant Tencent are under the wheels as well. To put it into perspective, Tencent is currently worth about 546 billion on the stock exchange. That means the WeChat mom has lost about 396 billion in market cap since the February mid-high. This illustrates impressively the consequences of Beijing's turnaround on the stock markets. While the leadership had long viewed internet companies as a driver of innovation and as a symbol of China's growing economic potential, things have changed now. And that I will explain later on why. And the industry is now seen more as a security risk and the cause of social problems. This is of immense importance in the People's Republic because political and social stability has the highest priority for the Communist Party. And why is that so? 2 examples. First, let's have a look at the tech companies and what is the real reason next to the data and security issues, which is controlled by the CAC, the Cyberspace Administration of China. And I think the best way to do so is to state what the Chinese person has to say to this. And here a shout out to Wade from the Discord channel West Money. And if you're interested in the Chinese stock market, then I recommend to check out this Discord channel as you get the latest news, what's going on in China. But let's hear what he was saying to that. So he says around 2012 the internet was growing rapidly thanks to the development of technologies such as 4G and cell phones. And the capital markets were abundant in liquidity. Back then, the country encouraged mass innovations which were essentially expected to generate more jobs and social activities. But now the tech giant's limitation is clearly visible. The bulk of its revenue coming from ads, e-commerce, games, and that didn't bring additional markets. Advertising used to be around as it evolved from traditional channels to internet channels as well as e-commerce. In the name of the country, there are just different groups of people who take the money from the original groups, which does not bring welfare to the society. Gaming is an incremental market, but it's eating up users' time and displacing other industries like batteries, semiconductor or photolithography and other really tough technologies. So I see here that the next measurements will be taken against the gaming industry. Be aware. And he says further, there aren't a lot of people flocking to this hard tech industry. The most important thing is that the main business of this internet did not bring additional job demand. So, for the goal of the shared prosperity and long-term gains, China needs to develop the hard technology mentioned above. The confrontation between China and the United States make that government realize this even more deeply, Wade said. Many thanks, Wade, for your insight. And I can understand all these points, but for me personally, and the most important for me, is I can't accept that the CCP or the CAC is the prosecutor, the judge, and the enforcer in the same time, and can punish a company in such a short time. And just as an example, compare for example Alibaba or Tencent and Facebook or Alphabet, and check out the prosecution time and the result via Google. You will be amazed about the differences. But now let's have a look at the second example, the online education market. China sweeping new rules in private tutoring has left private education firms facing a significant business impact as Beijing steps up regulatory oversight of a 120 billion industry that investors had bet billions of dollars on in the recent years. The new rules bars for profit tutoring in core school subjects in an effort to boost the country's birth rate by lowering family living costs. So, to understand the CCP and their doings, in May, China said it would allow couples to have up to 3 children from previously 2. And more than 75% of students aged from around 6 to 18 in China attended after-school tutoring classes in 2016, which is massive. And according to the most recent figures from the Chinese Society of Education, and anecdotal evidence suggests that percentage has risen over recent years. So, citing a person in charge at the Ministry of Education, A Xinhua report on Sunday said the move was needed to tackle a huge burden on primary and middle school students and their parents' finances. Dave Wong, portfolio manager at New Risk Capital in Singapore, said, "The Chinese government has always been more particular on sectors that have widespread social implications. So some parents, however, struggle to understand how the new rules will impact the education of their children. In the long run, it is definitely good news for the children as they don't have to immerse themselves in endless homework," said Zhu Li, a Chinese parent in Hayden District in Beijing. And if you ask me, I don't think it is a really bad move, and I wished other countries, I won't mention any names here, but I think you can imagine which one I mean, would care more about the kids and the stress and the financial burden in order to go to a proper school or college as well. But as an investor, if this is a really good idea, I don't really know. But what the heck you should do now? Well, I can tell you what to do as it depends on your investment strategy. But my strategy for now is to have maximum 20 or 30% China in my portfolio and not more. Means, as I am already invested in BYD, and thank God, until now it's not really affected by the CCP, and I hope it stays this way, I will not buy more China stocks for now. As for me, the risk is just too high. And instead, I recently invested in ZEV, which is the name Lightning eMotors, and is a 100% US EV company. And if you want to check out the analysis to it, I will link it up here. And that being said, if you want to take the risk and you don't have any China stocks in your portfolio yet, it could be a good time to invest, for example, in Tencent or Alibaba. But that is totally up to you if you can accept the risk I mentioned prior in this video. That's it for today. Let me know in the comments below what you think. Have a great day, everyone, and as always, stay focused and don't get greedy. See y'all next time.